watching the 10-year Treasury this morning. The yield breaking below 1.3% yesterday and below 1.26% right now. Join us now, Mark Grant, B. Riley Securities Chief Global Market Strategist. What have you decided about your view on the 10-year at this point, Mark?
I'm going to answer your question in 1 second, but I want to say something to you and encourage all your viewers to join me. Joe Kernan has been now the host on Squawk Box for 26 years. And that's quite an accomplishment, and I wanted to just say congratulations.
Thank you. Thank you. And 30 years, nobody really noticed, but 30 years at CNBC.
Wait,
if
today
you can believe
is your
that.
anniversary?
God
No,
bless.
it was a couple weeks ago.
Oh,
but,
okay.
No fruit baskets, nothing, I don't know.
So the answer to the question you asked me, Joe, is...
I thought you were going to say 26 years is long enough, because I get that a lot on
No, I'm not saying that.
on
Thank
Twitter.
you.
On Twitter.
Congratulating you.
Thank you, sir. I appreciate that.
So the 10-year is at a 126. As surprising as that these low yields are hurting all kinds of people, and they're being accomplished by the Fed and the other central banks being in, but it's causing a huge problem. And frankly, I wrote a piece in my commentary this morning out of the box. Bonds have no value left, not on an absolute basis, not on a relative value basis. And as a matter of fact, we're seeing corporate bonds, mortgage bonds, and even high yield bonds at the tightest spread ever to treasuries. And there's just no value in the bond market left. And it's also making a comment that all the squawking, if you will, about inflation isn't having an effect, because inflation has become an influencer of what the Fed does. It's not a driver of the markets anymore.
Wow. It's a global marketplace, obviously, Mark, and we don't, we need to remember that. We have our yield curve here in this country, but considering that money moves cross borders so easily, if you have a stable dollar, doesn't it make sense that the rest of the world still wants to buy our 10-year? Or is it artificial from the Fed buying anything in sight to keep, to keep QE going and to keep rates low? Which is really affecting it, do you think?
Well, both, Joe. The answer isn't one. The answer is both. One is the dollar itself. But two, Joe, if you look at the European Union, you can go across any country you want, including Italy, Greece, and the smaller countries in the European Union, Japan, Switzerland. Their yields are all significantly lower than American yields. So that's driving some money here. And also their central banks are much more aggressive than the Fed's been. I keep wondering, frankly, Joe, if at some point with the issue of treasuries having to do with the stimulus packages that the current administration is proposing, if the government's, the Fed is part of the U.S. government. We're not talking about independence here of the governors or the presidents. The Fed, by the Federal Reserve Act of 1913, is part of the U.S. government. And so I wonder if the current administration isn't going to come along and say, gee, how come our yields are so much higher than everybody else's yields? And why can't you get these more in line? So I think we're going to see a continuing downward slope in bonds, no yields, no relative value, no absolute value. And what I've said, just so you know, Joe, to my institutional and retail clients is shift, pivot, and start looking at closed-end funds and exchange-traded funds where you can get outsized yields, compared to corporates or mortgages or even high yield. You can get way higher yields in some of these closed-end funds and exchange-traded funds than you can find in the bond market.
Mark, more or less in terms of stimulus, do you think, from let's talk about fiscal stimulus, more or less is going to help the economy and the markets? Because now we're hearing we're not going to get any more stimulus, so maybe the market should go down. Is it ever going to be enough is enough?
I don't think it's going to be enough is enough for years, Joe. I think there's tremendous pressure to keep interest rates low on all the central banks and the governments that they represent. And the reason is they're issuing debt and they can't afford. And I mean that exactly. They cannot afford higher interest rates. So it's great for the government, great for the governments. And it's terrible for investors, especially individuals that used to have, some part of their portfolio was in bonds and for income, and they can't get it, which is why I keep saying pivot to closed-end funds and some exchange-traded funds. They're complicated. You've got to know what you're doing, but you can get a heck of a lot more yield there than you can in the bond markets.
All right, Mark Grant, thank you. How long you been doing that? You make me look like a kid compared to how long you've been in this business, right?
47 years, Joe. I've been on Wall Street. 47.
See?
Wow.
17 years, me and you, 17 more together. Well, Melissa, think about that. Off and on, is that okay?
Not
We are.
together.
Sometimes we are. We're together now.
Off and on, I might be able to tolerate.
Oh, boy. All right.
Well, listen,
That's a good start. Thanks, Mark.
Up
See ya.
next.